Today on Money 101, we look at an alternative approach to investing. Recently, Amanda Lang spoke with David Kaufman, president of Westcourt Capital, and she began by asking him how categorizing investments by risk is different from what investors typically do now.
Essentially, most people categorize their investments like we all know about stocks and bonds, and then there's usually like a third category. Traditionally, we'll call that alternative investments. Some people call it real assets, inflation protection, and all of those names are designed to try and explain sort of what role those investments are playing in the portfolio. But at the highest level, the names are meant to tell us something about the risk that we're taking. You know, most people understand that equity has a higher risk than, say, bonds, but it doesn't do a very good job of explaining relative risk within those areas, and that's why we much prefer to leave sort of some of the more traditional nomenclature behind and go to a really, really simple approach, which is the ABCD approach.
And the ABCD approach basically says, what is the risk? What is it? So what are the characteristics of this thing under that umbrella? So walk me through them.
Right.
What does each letter stand for?
Yeah, so so we're saying let's divorce ourselves from whether it's called equity or fixed income and take a look at how much risk there is, as you said. So a good example, an A would be very, very unlikely to lose money in any circumstance, but also very unlikely to provide you the kind of rewards you might need, the kind of returns you might need to live on. An example of that would be a Government of Canada bond or a GIC, that you know it's very safe, but these days with low interest rates, you're probably not getting there. An A would be in that category. B is a much bigger category where you're very unlikely to lose your money over the long run. You're more likely to get the kind of returns you're looking for, but there's something about it, whether it's a little bit less liquid, it could be private, for example, or that it could be a little more volatile, that makes it a B instead of an A. And Bs are generally what people would live on. So people that are retired and they have a large portion of their assets in which they're planning to live would be a whole bunch of Bs. Cs, and if you wanted to, you could say C plus and C minus, but Cs are basically equities. They're much more volatile, but they're also much more likely to cause the growth in your portfolio over time. Yep. We all know that, you know, equities can be, you know, Canadian dividend-paying equities, or it could also be, you know, virtually illiquid penny stocks and resources, and those are not the same thing. Right. And then finally we have Ds, which are speculative, and that's just a pure bet on, like, for example, venture would be speculative, where there's a good chance that you'll lose all of your money most of the time, and then there's some chance that every once in a while you'll have a home run.
Now, as you noted, there would be a lot of Bs in, say, a retired person's portfolio. Would you break it down in terms of the mix of risk classes, pretty much the same way others do when they're talking about assets? Because people will say, you know, it should be 60% equities, 40% bonds until a certain age, and then you swap it. Do you buy into any of that, or is it very individual?
The whole concept of 60-40 was born out originally of how much risk am I taking. It's that, you know, when the equities are performing well, that's what I'm going to depend on, and when they're performing less well, maybe the 40% will act as a buffer for me. Yeah. We look at it the same way, and you can do it two ways. You can basically have all Bs, in which case you're going to live a nice, happy, long life, but you're very unlikely to have massive growth over time. Or you could barbell it, where you could have some A's, which is to make sure that no matter what happens, I have some money in my back pocket, you know, under the mattress, ready to go, and have more C's so that you can have growth over time and skimming off the top. Usually the older that you are, or the more defined you are with respect to the kind of distributions you might require, you'd probably have more simple B's because it's more predictable than having the barbell.
One of the challenging things, and it's especially challenging for people like you who actually manage people's money, is because of what interest rates have done. There was a time in my lifetime when you could have lived on A's. You could have got yourself some GICs and generated 6-7% returns, and that's enough to live on. Not true anymore. And in fact, a lot of those Bs, the kind of stable ones that aren't going to surprise you too much, even they aren't returning enough. So it does send you up the risk chain a little bit. How do you manage that? How do you cope with it?
That's the $64,000 question. It's a very difficult question to answer, because I can tell you what the answer shouldn't be, is that many advisors say, well, let's have this rotation into dividend-paying equities. Right. So yes, it's true the dividends are both tax efficient and much higher than, say, investment-grade bonds, but at the same time, you know, you have this potential for massive swings and volatility in the value of the underlying equities. So what we encourage people to do is to give up a little bit of liquidity in part of their portfolio and access more of the private space, which is the Bs, so that they have A-like risk, but because they're less liquid, they're a B, and that's how you can start to access the 6, 7, potentially 8% returns, which used to be pretty standard, to your point, years ago, and now you have to actually stretch things out. So rather than taking equity-like risk, we'd rather take other risks, such as a little bit less liquidity.
And so, finally, how often would you be rebalancing this? How often would you be looking at somebody's portfolio and saying, you need more C and less B?
Well, if you're in the B camp, virtually never.
Right.
However, if you, it's about age, but it's also about stage. So that if someone wins the lottery, they can see it up. They can even add a few Ds in there. It's when things change in your life. Your kids move out, and now it's time that you're going to do different things with your life. You don't have to have them all on the payroll at the same time.
Right.
If you don't need active distributions, that's the sort of thing that would allow you to balance up on the C's to allow for growth. And no matter how you are allocated, you have to make sure that you're keeping up at least with inflation.
Thanks, David.
Pleasure.